Now, as we are in the midst of our first trading day of 2025, our next guest says Canadian stocks are much better positioned than their U.S. counterparts when investing in 2025. For more, we're joined by Gavin Graham, Chief Investment Officer and Portfolio Manager of Spire Wealth Management. He joins us from England. Gavin, great to see you. We haven't done this for a while.
Great to see you too, Mark. Nice to have you back. And yes, it's been a really remarkably strong couple of years for North American markets, US markets in particular, especially the Magnificent Seven stocks. It seems fairly optimistic to expect a repeat of that this year, and therefore looking at something like Canadian stocks, which are much more attractively valued, would seem to be a sensible choice.
Right, and we'll move into that. But speaking of the Mag 7, you're looking at the concentration, essentially those 7 companies making up nearly 20% of global market cap. And you make the comparisons, and others have too, that valuations are similar to where the Nifty 50 were trading in the 70s or the .com stocks in the late 90s. So can we extrapolate from that, Gavin, that they're in the most expensive stocks, the Mag 7, could there be tepid returns the next few years potentially?
Absolutely. And again, and as you say, I'm by no means the first person to be pointing this out. Valuation is not particularly useful in terms of timing, but it is very useful on a longer term view in telling you what your returns are likely to be. And we are in the top 5% of the most expensive markets in the last century, including, as you mentioned, the Nifty 50 in the early 70s, and particularly the internet bubble in 99, 2000. And the returns you made over the next 10 years from markets were in the region of 0 to 3% per annum, and that included dividends. If you pay a really high price for something, the returns you get will not be very attractive. And I make the comparison with buying government bonds below 1% in the middle of the COVID panic back in 2020. And you had no protection at all in the event that inflation came back. Oh, look, inflation came back and you ended up losing 20% of your money in the government bond market in 2022. Now, bonds actually look relatively interesting because they're paying 3.5%, 4.5%. But again, if you buy something when it's really expensive, you won't make very good returns going forward.
All right, Gavin, back to Canada, where you see better value. You like certain sectors, and some of the names you're mentioning here in financials, RBC and Manulife, Capital Power, Enbridge, REITs. Can you elaborate on your concept here that Canada is a better place to be?
Yeah, for a start, even though it did pretty well last year without having any of the Mag 7 stocks, I think the TSX 60 was up 18% against 25 for the S&P 500. It's got a big exposure to financials and interest rate sensitives. And obviously with rates coming down, we're down remarkably enough, Mark, 1.75% in Canada. Canada's been the market leader in cutting interest rates, perhaps because the Bank of Canada is distinctly worried about the slowing Canadian economy and the effect of high interest rates have been having on the consumer. And as a result, the interest rate sensitive sectors, which is pipelines, utilities, financials, REITs, telecoms, actually are starting to do better, although with the continued increase in 10-year government bond yields, ironically, the Fed cut rates 100 basis points in the last few months. Longer-term bond yields in the US are up 100 basis points, which might reflect the fact that there's going to be a very, very large amount of US government bond issuance. But either way, the financial sectors have started to do better. The pipelines, the utilities, the financials. In fact, some of the strongest performing stocks have been things like World Bank, National Bank, Manulife, and the same thing in the States. And realistically, there's going to be further interest rate cuts. So these interest rate sensitive sectors look good. One interesting area, you touched briefly on the REITs, both retail-centered REITs and apartment REITs have actually been lagging somewhat, even though interest rates have been coming down. We all know the difficulty of getting rental apartments in Canada, and retail, especially grocery-based retail, has proved to be extremely resilient. So those sectors of the REIT market look really interesting.
Now, in the energy sector, Gavin, specifically with natural gas, which has been quite hot lately, in part because of expectations of much colder weather in the U.S. in the next couple of weeks. But a couple of names you mentioned are Peyto and Tourmaline. Do you have some preference there?
Well, Peyto, actually Tourmaline has been the better performer. and is probably the most fashionable pick, as it were, and done really well. But Pato has done really well. And again, gives you a really good running yield, and it is the lowest cost gas producer. So therefore, even when you had a big sell-off in the price of gas in 2022, it still actually was able to be cash flow positive and very profitable and maintain its dividend. So those are sectors we think look interesting. And realistically, also, of course, we've just had Ukraine ending its supply arrangement with Russia. So European gas prices have started to spike. It's quite cold over here in the UK. We've actually, remarkably enough, got snow, which you almost never get in the UK. And that's likely to put a bid under gas prices generally. But as you say, it generally tends to be pretty much a local weather-related market in the short term in North America.
And then, Gavin, on the precious metal side, you recommend that investors should have about 5 to 10% of their portfolio in gold miners. I'm looking at Agnico Eagle, for example, year over year, up 63%. That sounds pretty robust. But do you think that the gold miners have actually even kind of underperformed gold, which was up 27% last year, best performance since 2010, that these miners could do even better?
They could. For a start, gold actually beat the S&P 500, not the Mag 7, obviously. And yet, money's been coming out of gold ETFs. I'm not sure whether you saw, but the Spider Gold actually has less gold in it than it did at the beginning of last year, even though gold's up 27%. And while individual well-managed stocks like Agnico, which is one of my largest personal positions, and there's been a long-term recommendation, have done pretty well. Barrick and Newmont, which are the two big North American gold miners, have actually been unable to get out of their own way because they've had production issues and corporate governance issues and the rest of it in Africa. So gold mining stocks are at their cheapest relative to gold virtually in their history, and certainly for the last 10 years or so, which is slightly odd because they're a leveraged play on the price of gold. Because if the price of gold goes up, every single additional dollar on an ounce of gold should drop straight through to your bottom line. So you ought to actually go up 2 or 3 times as much as gold, which is what tended to happen in previous gold bull markets like the early 2010s and 2020, but just not really been the case so far. So Agnico, Alamos, Pan American Silver, Franco-Nevada, we think look pretty attractive. And by the way, you're getting paid reasonable dividend yields now because they are using their excess cash flow not to make overpriced acquisitions, but to actually give it back to shareholders.
Lots of ideas there, Gavin. Thank you very much, and have a great 2025.
And you too, Mark. Happy New Year.